$500 million doesn't just vanish. No hacker stole it. No market crash erased it. It was routed, deliberately, through a hidden path of shell companies, fake returns, and layered transfers designed to make the trail go cold. Billions disappear this way every year, and most is never recovered. So where did 500 million actually go? The answer starts inside the machine that made it disappear. This pattern repeats daily across every major financial hub on Earth. While headlines portray these losses as isolated incidents of clever theft or rogue actors, global regulators track a different reality. Aggregate data reveals that annual losses from investment fraud now run into the tens of billions of dollars across multiple international jurisdictions. The public often imagines a single thief carrying a suitcase of cash across a border. But modern financial crime operates through highly organized, repeatable systems. The money does not disappear because of a single lapse in security. It is systematically absorbed by a structural architecture specifically engineered to exploit institutional blind spots. What looks like a sudden, catastrophic collapse is actually the final phase of a highly calculated process that converts public trust into a permanent, untraceable deficit. Inside this architecture lies a deceptively simple mathematical engine. Imagine an investment fund that launches with exactly 100 investors, each depositing $1 million. This establishes a starting capital pool of $100 million. The operator promises a steady, highly attractive return of 8% every month. To the untrained observer, the resulting payouts look like the fruits of successful trading. In reality, there is no underlying commercial activity. No stocks are bought, no currency is traded, and no real profit is ever generated. Instead, the system relies entirely on a circular cash flow, where money from newer participants is used to pay returns to those who joined earlier. In the first month, meeting that 8% promise requires exactly $8 million. This money is simply carved out of the initial $100 million pool. But as more investors join to chase these consistent gains, the math quickly becomes aggressive. By month 2, if the capital base doubles to support the growth, the payout demand rises to $16 million. By month 3, the monthly requirement climbs to $32 million. By the 6th month, the pressure becomes extreme. To maintain the appearance of solvency and meet the accumulating payouts, the scheme now requires $256 million of fresh cash in that single month alone. The cumulative demand for new capital over those 6 months breaches $500 million. This exponential escalation exposes the fatal flaw of the system. Forensic analysis of these cash flows highlights a single, compounding vulnerability. Because the fund generates nothing of its own, it survives only as long as the influx of new deposits exceeds the outgoing payouts. The moment investor recruitment slows, or a wave of depositors requests to withdraw their principal, the capital curve instantly breaks. Without a continuous, massive injection of new millions, the entire structure collapses under its own weight, leaving the vault completely empty. When the system collapses and the vaults are found empty, the stolen $500 million has not actually vanished. It has been routed into 3 distinct destinations. The first portion remains trapped in sham investments. These are entirely fake accounts existing only as digital ledger entries, designed to show fabricated growth on a screen. The second portion is consumed by the scheme's daily operation. This cash is split between funding the operator's high-end lifestyle and paying out false returns to earlier depositors, maintaining the illusion of a healthy fund. The third, most problematic portion is immediately transferred outward. These funds are wired to offshore entities the moment they enter the system, specifically timed to outrun forensic tracing. This structural division ensures that by the time regulators lock the doors, the assets are already distributed beyond the reach of local courts. The outward transfers flow immediately into front companies. These are legal entities established in offshore tax havens specifically to hold assets, with no actual offices, employees, or business operations. To distant regulators, they look like legitimate international enterprises. To disguise who actually owns them, operators hire nominee directors. These are third-party representatives who sign the registration paperwork for a fee, keeping the true architect's name off all public registries. Once the first shell company is active, the money does not sit still. It is quickly routed to another shell entity in a different country, shielded by a web of paper agreements. The most common tool is an intercompany loan, a sham debt agreement where one shell company lends the stolen funds to another. This creates a paper trail that mimics standard commercial finance. An anonymous anti-money laundering investigator explained that every time the money hops across a border, the forensic trail goes cold. A single request to trace funds across jurisdictions requires complex international legal requests that can take up to a year to process. By then, the money has already moved through 5 more countries. While traditional banking networks require days to clear international wire transfers, modern digital networks bypass these checkpoints entirely. Cryptocurrency rails allow hundreds of millions of dollars to cross borders in seconds, moving peer-to-peer without intermediary banks. To keep victims quiet while their funds vanish, operators deploy fabricated trading dashboards that display completely simulated balances and returns. Behind the screen, no real trading occurs. Database entries are simply updated to mimic market fluctuations. On the back end, automated scripts and API-enabled bots execute the actual movement of stolen capital. These programmed transfers slice large deposits into fragments, scattering them across dozens of temporary wallets in a rapid series of transactions. A blockchain forensics analyst notes that these automated steps occur too quickly for human investigators to track manually. By replacing a physical back-office staff with automated software, a single operator can manage thousands of transfers simultaneously. This programmatic speed turns what used to be a weeks-long laundering operation into an instantaneous sequence, sharply reducing the response window for law enforcement. The chase becomes entirely reactive, starting long after the assets have already been settled in safe havens. While automated systems move stolen capital in seconds, the institutional machinery designed to stop them operates in a completely different temporal reality. Reconstructing a complex, multi-jurisdictional fraud requires regulatory bodies to build cases using traditional, paper-bound legal channels. Gathering evidence across international borders relies on mutual legal assistance treaties, known as MLATs. These formal requests must be reviewed, approved, and translated by foreign ministries, a procedural bottleneck that typically takes 6 to 12 months. and often exceeds 18 months in uncooperative jurisdictions. Operators exploit this friction by deliberately headquartering shell companies in countries that delay legal assistance. While investigators wait for bank records to clear international channels, the operators simply pivot, targeting entirely fresh pools of investors to keep the scheme breathing long before the first asset freeze can be ordered. Once legal enforcement halts a scheme, the prospects for victims are grim. Aggregated regulatory enforcement reports reveal a stark pattern. Between 80 and 95% of stolen funds are never recovered. Forensic accounting analyses of these liquidations show that layered offshore opacity and rapid digital transfers successfully shield the assets from court-ordered restitution. Instead of full recovery, receivers typically claw back only pennies on the dollar, leaving the remaining hundreds of millions permanently lost in the shadow financial system. Subscribe to track how global wealth disappears. Today, those millions aren't lost. They are actively working in the shadows of a parallel economy. As financial technology accelerates, the next digital maze is already being constructed. The true danger is our own desire to believe. Subscribe for more investigative breakdowns.